This week revealed just how fragile and interconnected the global economy really is. The Fed remains boxed in, unable to maneuver. China signals trouble beneath the surface, hinting at deeper issues. Oil markets are behaving irrationally, defying expectations. Meanwhile, Washington bets on AI exports to shift the trade balance. And we close with a key tax insight. Understanding capital gains could save you serious money. Fast-moving markets, smart analysis. Let's dive in.
Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Rob Ferry, and he's the CEO and founder of Flying V, our digital marketing partner. Rob, how you doing this week?
I'm doing great, Gary. How are you? Happy Monday. Excited to get into the AI for everyone issue. How are your travels going? Where in the world is Gary? Have we started that tracker yet?
Yeah, so Rob, it's really interesting. When I told everybody I rented out my house for a year and I was going to travel, the first question everybody asked me is, where are you going? And I decided to spend the first month on who am I visiting. So last week I was in New York staying with my old partner, Raji Kabaz. I got to see his son's first communion, caught up with Lawrence O, another member of the DKI Board of Advisors, had a dinner with Kieran Pignali, the CEO of Telk, someone I haven't seen in a few years. It was a great chance to catch up with everyone. Last Friday, I took a 9-hour train to Pittsburgh, where I'm currently visiting with my favorite cousin, Rob, my great uncle, Herbie, who's 96. I had dinner with him last night. It's really great to see everybody. Later this week, I'll be headed to West Palm Beach, Florida to visit some clients and my best friend and member of the Board of Advisors, Howard Friedland, there. So I'm really not focused on where I am. I'm focused on the people I haven't seen in far too long.
Love it. I think that's a great way to travel. A great perspective there, Gary. Like I said, we have the AI for everyone issue. We're going to do things a little bit differently this week. So if you watch the full version of the 5 things or tune in for our educational topic, generally we'll do this as our 5th and final thing for the show. Today we're actually going to flip it upside down. Going to be our first topic. Call this our educational topic. Try and educate beginner, intermediate, even advanced, depending on the topic levels of investment advice or ideas, what to know, what to look out for, etc. Gary, you mentioned it in the intro. We're talking understanding the difference between short-term, long-term capital gains. I think my wife the other day just found out about capital gains and was really upset about it. So I'm going to definitely send her the link to this segment after so she can get everything she needs to know. Gary, I'm going to turn it over to you. And we also have a guest, which we're really excited about, if you wouldn't mind doing the intro.
Of course. Well, Rob, since we are talking about taxes, short-term, long-term capital gains, it was the right time to bring in Michael Kliegman. He is Deep Knowledge Investing's tax and accounting advisor. He's on the board of advisors. Michael Kliegman has more than 35 years of experience in tax-efficient planning for mergers and acquisitions, corporate restructuring, and private equity transactions, as well as prior experience as group chief in the Internal Revenue Service National Office. Don't hate him for that. He was just doing his job. Michael joined Aiken Gump as a senior counsel after a long career as a partner in the New York Mergers and Acquisitions Group at PricewaterhouseCoopers, where he specialized in due diligence, structuring business acquisitions, and reorganization. Basically, there is no one more qualified to talk about taxes than Michael. Thank you for being on with us.
Thank you, Gary. And thank you, Rob. It's a pleasure.
So, Michael, first question, do you file your own taxes?
No, in fact, I was going to say the only person more qualified than me to talk about this stuff is the person that does my tax returns.
All right.
However, they're too busy right now, so I'm available.
All right. Well, perfect. Glad to have you on. Thanks for making the time, and thanks for being part of the Deep Knowledge Investing Board of Advisors. Let's start with the basics, Michael. What is the difference between a short-term capital gain and a long-term capital gain?
Okay. I'm going to answer that question by first indicating why you care. Okay. So our ordinary income that we have from whatever sources taxed at whatever the maximum rate for you is, maximum rate for anybody is 37%. Long-term capital gains are taxed at a lower rate. Maximum rate for maximum rate for the wealthiest is 20%. If you're in a lower bracket, it's going to be lower still. That presupposes long-term capital gain. So let's say we're talking about stock, because that's kind of the what Gary talks about most, at least in terms of investment advice. If you hold the stock for more than a year, you're in long-term capital gain or loss when you sell that. If you've held the stock for less than a year, or a year or less, I should say, when you sell it, then it will be a short-term capital gain or loss. Let me pause there a moment.
Okay. So, Michael, what you're saying is, depending on your income level and what state you live in and what your state taxes are, turning a short-term capital gain, if you go over that 365-day mark and turn it into a long-term capital gain, you potentially are saving 50% or more on your tax bill from those gains. Is that a basic way to summarize it?
Yeah, in the highest bracket, if I just have short-term capital gain, it'll be taxed at 37%. Again, put aside state, that's on top of it. 37%, the same as your salary or anything else. If I get over the 1 year mark, long-term capital gain, then it'll be maximum rate of 20%.
Okay, so if we end the year with capital gains, by April 15th the following year, we have to pay taxes on that. Whether they're short-term or long-term, you have to pay taxes on the gains. What about losses? What do you get if you lose money, aside from embarrassment in my position?
So in a moment, what we're going to talk about is putting together your gains and your losses, how that works, because you may have more than one investment that you realize on during the year. But if I've got a net long-term capital loss for the year, then I can only offset long-term capital losses against capital gains. They let you deduct, if you have a net long-term capital loss at the end of the year, they let you deduct up to $3,000 against your regular income for a married couple filing jointly. Beyond that, it carries forward to the next year. So it'll enter into your capital gain and loss schedule in the following year.
Okay, so if you have capital losses, they would first go to offsetting your capital gains. After that, if you still have more losses, you can apply a $3,000 deduction against your ordinary income that year. And if you still have more capital losses, you can carry the remaining amount forward to be used in subsequent years. Is that a good summary?
Yes.
All right. So for other people who are just, learning the basics of all of this, what other topics do you think they need to understand?
Well, the following. So you're going to, when you do your tax return for a given year, or your accountant does tax return for a given year, you're going to go investment by investment that you've sold during that year. If you haven't sold it, doesn't measure other than dividends. You'll have gains and you may have losses, and you'll have short-term gains or losses and long-term gains or losses, and all of that goes on the schedule, and they net together. You'll end up with either a net gain, a net long-term capital gain, or a net short-term capital gain, or a net short-term or a net long-term capital loss, or net long-term short-term capital loss. That nets together, and you end up with one of those four things that's going to either be taxed at the reduced rate if it's a long-term capital gain, or potentially reduce your income and carry forward if it's a loss.
All right.
That sounds complicated. A couple of things. One, uh, if you have an investment, a mutual fund investment, the mutual fund is buying and selling stocks during the year. Um, and you'll find out when you get a 1099 that you probably have capital gains that have passed through to you. When they pay dividends, which they do, they pay out all their income uh, usually. To the extent there are realized capital gains by the mutual fund, that's gonna end up on your tax return, even though you didn't sell the mutual fund.
Right. So the key thing for people to know is if you have investments in mutual funds, not just individual stocks, you may get a tax bill, sometime in January or February that will be due in April, and you won't know what that is before you get it. And so you need to leave some cash aside to be able to pay that tax bill.
Okay. Another point, none of what we just talked about matters for investments in your IRA or 401k or similar qualified plan. And that's where a lot of people have most of their investment dollars. So that sounds great because it doesn't matter. It's not taxed. But when you eventually take it out, it all comes out as ordinary income. You don't get the benefit of reduced tax on long-term capital gains for what's in there.
So I think for most people, though, they prefer the advantage of 40 years of tax deferrals
Absolutely.
to having to pay a potentially higher tax rate in the future. The other thing that's worth pointing out is in the case of people who start to draw down their IRA or their 401k, those people have often retired, and so they might be recognizing that income at a time when they don't have as much W-2 income, so their tax bill might not be as high as they would expect had they paid those taxes during those working years.
Yeah, but I was not recommending that you avoid that you not take advantage of qualified retirement plans. And I'll mention just one other thing. If you're in December and you see you've got capital gains and you want to look around for capital losses, stocks you could sell to recognize a loss, that's generally a good idea. The brokers sometimes call that harvesting capital losses. That's fine, but there's something called the wash sale rule. So what you might think you want to do is sell your stock at a loss, but you still want to hold it. So you're going to buy it right back. You've got to wait 30 days. If you buy and sell the same stock within a 30-day period, then they won't let you recognize a loss on that. That's getting a little
So
fancy, but good to know.
yeah, no, Michael, that's actually relevant to me. Last December, I had a lot of capital gains. I wanted to harvest some losses, but I still wanted exposure to that position. And so what I did was I exited the position and bought options. And it was a way to maintain exposure, but keep myself in line with the wash sale rule. So these things, they might sound a little esoteric, but these are practical strategies that we use on an annual basis at Deep Knowledge Investing to try to pay as little taxes as possible legally, right? Try to use the system in the way that will reduce your tax bill, but also keep you out of jail.
I know that was a joke.
What's that?
That was intended as a joke. I said,
Yeah.
a smile on your face, right?
Yeah.
Or at least avoid civil penalties.
Right. We recommend that you follow whatever your local tax laws are, and the way that we use these wash sale rules, or what Michael talked about, harvesting losses, the strategies that we employ are legal and they're carefully designed to make sure that we don't violate IRS rules or SEC rules or anything that would cause problems down the road. So that's not a joke. It's important to know what these rules are and to apply them properly so that you can legally keep your tax bill as low as possible. All right. Well, Michael, thank you so much for joining us. Really
My
great to
pleasure.
have you on, and we appreciate your time and expertise.
Great. Thank you. Enjoy the rest of the program.
Thanks
Thanks.
so
Take
much,
care,
Michael.
Michael.
Awesome. All right, great stuff there, Gary. And again, this is the 5 things to know in investing this week with Deep Knowledge Investing, the AI for everyone issue. Gary, we've got the Fed meeting coming up, talking about that here in a minute. Oil's coming up as well, China and interest rates. And then we're talking the current White House and export restrictions. So let's get right into it. Thing number 2, Gary, we're talking about the Fed meeting. Nothing happens. No one's surprised. Thing number 1, Fed meeting contains no surprises. Come on, Gary. Give us
Yeah,
some.
I know. Rob, as my marketing guy, how do you not stop me from telling people nothing happened, nobody cares, it doesn't matter? Why is anybody watching? You're supposed
I
to
don't know.
stop me
You see
from saying to
the
people,
hand I've been dealt now, huh?
right, exactly. So everyone, we're about to explain something to you that doesn't matter. If you want to spend this time with us, thanks. We're glad to have you. But the Federal Reserve Open Market Committee, or the Fed, they meet every month. And each month they make a decision on what they want to do about the Fed funds rate. In this case, their meeting concluded last Wednesday and they took no action. They left the Fed funds rate unchanged, which surprised nobody. I think there was a 97, 98% probability that they were not going to change anything. And in my opinion, that was the right move. The one thing that did change in the text, I like to read the press releases. The Fed did emphasize increasing economic uncertainty, and that's analysis that I consider reasonable. I think Chairman Powell remains painted into a corner where any reduction in the Fed funds rate is likely to lead to more inflation, which is still not under control. But his problem is that raising rates would both cool the important labor market and strengthen the dollar. And normally, we think having a strong dollar is terrific, but remember that the US has the more debt than anybody in the world. We're trying to inflate that away. And more importantly, President Trump has been very focused on trying to reduce the trade deficit. So remember, in that situation, a stronger dollar creates a headwind. When the dollar is strong, it's easy for us to buy foreign goods. It's hard for people in other countries to buy US goods priced in dollars. A weaker dollar will make imports more expensive and will make our exports less expensive to our trading partners. So if we haven't been nearly as apoplectic about potential tariffs as most people have been, but in this situation, a stronger dollar would be working against President Trump's current policy desires. And so, that's why it's very difficult for the Fed to either raise rates or lower them. They left them unchanged, which is what everybody expected. And again, in my opinion, I think that was the right move at this time.
Yeah, so Gary, no surprises here. We talked about it last week. This was to be expected. Why do President Trump, so many investors want to see the Fed cut the rates?
Well, the reason is because, the reason President Trump likes to see that is because it juices the economy, right? If the cost of borrowing is lower, asset prices go up. And also remember, Rob, when it costs less to borrow, there's a greater incentive to build, to put up new plants, to build new housing, whatever you want built that will make the economy look better. That's obviously to President Trump's advantage. And that's something that he would like. And so that's why, and investors want to see lower interest rates, because lower interest rates means you're discounting future cash flows from the companies you own at a lower rate, which increases their value. And so you typically will see when the Fed lowers the Fed funds rate, the stock market tends to go up. Investors like that. Now, in my case, we've hedged against it. I don't wake up worried about whether the market's going to go up or down. I'm focused on our skill as stock pickers. That, to me, makes a lot more sense. The thing that I would encourage people to realize is the Federal Reserve does not control the whole yield curve. That's just a fancy way of talking about the rate of interest at various points along the yield curve. So the Fed controls the overnight rate, but the 1 month rate, the 1 year rate, the 5 year rate, the 10-year, all the way up to the 30-year rate, that's all set by the bond market. And so my view is if the Federal Reserve cuts, the bond market will then factor in higher expected future inflation. that raises the yield on the 10-year, which then raises mortgage rates. And so the point of all this is if President Trump got his preferred policy of a lower Fed funds rate, I think we're going to end up with higher 10-year rates, which is a problem for Treasury Secretary Bessent, who needs to refinance $7 trillion this year. That's a big number. We're going to have higher mortgage rates. Basically, I think President Trump's criticism of Chairman Powell has been valid, and I think Chairman Powell ignoring President Trump has been the right move. This is, again, one of those things where, depending on your point of view, you could say everybody's right, or our point of view is everybody in this matter is wrong.
Interesting stuff there, Gary, and we'll keep in tune with what the Fed decides to do in future meetings. Let's shift to oil. We're seeing something where oil inventories are falling. The prices are down as well, which, Gary, what should that be happening? It doesn't make sense to me, so maybe you can clear that up. With thing number 3, Gary, WTI drops as inventories fall. A market disconnect, ? Thing number 3, Gary.
All right, so Rob, you're right. This is a little bit of an anomaly. By the way, for people who aren't constantly following the oil markets, there are two big prices that are tracked. WTI stands for West Texas Intermediate. Think about that like a proxy for the price of oil here in the United States. The other one that people look at is Brent crude, Brent, and think about that as a proxy for international oil prices. Now, of course, they move together, and any dislocation in one will cause the other to react. Those prices tend to be similar, but in this case, we're looking at U.S. crude oil inventories, and inventories are down. Now, normally, you would think, wait a minute, falling inventories, that means you have tighter supply. What happens when supply is tight? Prices go up. And we took a look. Cash and Crow, DKI intern, did great work as usual. He's becoming a fantastic statistician. We're teaching him. But that correlation is 59%, almost 60%. To give you a sense, that's a meaningful number, but not determinative. So, if it were like 70, 80, 90%, you say, wow, one definitely controls the other. At 60%, you'd say, okay, this actually matters. And so 60% of the time that you have crude oil inventory coming down, you would expect prices to be rising. And what we've been seeing is the opposite. We actually have declining oil inventories, but prices are down as well. And so that's the thing that's kind of unusual right now.
Gary, I feel like I could ask this question about basically anything nowadays, but I think it's the obvious one here. How much is the tariff conversations, the discussions, affecting what's going on here in the oil markets?
Well, Rob, that's the big thing that's going on. Basically, what's happened, because the United States has threatened enormous tariffs against all of our trading partners, and in particular against China, and granted, we're filming this on Monday, May 12th. Things changed last night, but before last night, where the White House announced progress in getting a deal done with China, they don't have a deal done,
right?
But there was progress, and in fairness, the Chinese government they acknowledged that as well. Their view was, yep, we agree that we have progress here. But over the weekend, before we had that, people were worried that trade tensions between the U.S. and its trading partners, and between the U.S. and China in particular, were going to take down global growth. And what happens is, when you have less global growth, when everybody's GDP falls, energy prices fall, energy usage falls. And so basically what happened was, people were taking down inventories and saying, we're worried there won't be enough growth to support future oil production. That's going to bring prices down. And that was one of those uncommon moments where growth concerns reduce both the forward demand curve, in this case pricing, and the willingness to hold current inventory. Now, again, as of last night, when the U.S. and the Chinese government were saying it looks like we're getting closer to a deal, things are going to be better. Obviously, everything got revalued. All of DKI's oil and energy positions were up huge today. Because of that. And so, again, this is why we hedge these things, is what we were talking about earlier in the show. You never know what the next press release is going to be. And certainly, Rob, I think this is something you can expect us to be talking about leading off next week's 5 things. I can't imagine any bigger news is going to happen between now and then.
Yeah, definitely. And I think this is a good segue too into thing number 4. This would be thing number 3 on the written version. Again, we did the educational piece at the top of the show for this week. This is the AI for Everyone issue from Deep Knowledge Investing. Be sure to head to our website, deepknowledgeinvesting.com, grab a subscription there to make sure you don't miss anything. So, Gary, going right back to China, talking about them cutting interest rates. They're desperate for stimulus while pretending they don't care about a tariff deal with the U.S. That's directly from the written version of the 5 things. Gary, thing number 4, China's surprise rate cuts. Let's follow on to talk about this right after thing number 3.
Yeah, Rob. So one thing I've found hilarious over the last month is I've seen Chinese trade negotiators say, we don't care if we get a deal with the United States. It doesn't matter. It's irrelevant. Well, if that's the case, why are they cutting rates? They're, of course, cutting rates because they're desperate to stimulate their economy, which is not doing great. And China has similar debt problems to the United States. You know, on the show, we talk a lot about the US's massive debt and our overspending, but it would be a mistake to think the rest of the world doesn't have these problems, in particular China. So last week, in order to stimulate their economy, we talked earlier in the show about how lower interest rates incentivizes people to build and grow the economy, start businesses. They cut their 7-day repo rate from 1.5% to 1.4%. They lowered other relevant benchmark rates as well. And so, you know, after the US placed steep tariffs on Chinese goods, there were concerns that trade activity would contract, there'd be less of it, orders spiked ahead of tariff implementation. That's something we talked about in last week's 5 things. And so what China is trying to do is soften that economic blow, which led to last week's rate cuts. The other important thing on this is, remember, we were talking earlier in the show, if you lower your interest rates, that results in a weaker currency. So the reason China wants to do that is because if they lower rates and they weaken the yuan, then it's something China's done many times in the past to support its mercantilist policies. That will result in a weaker currency for them. And what that means is that their exports will be priced more cheaply, and it'll be more expensive for the Chinese people to import foreign goods. This was their way of responding to President Trump's tariff implementation, basically saying we'll stimulate our economy and we'll weaken our currency. That was their response, which is fine. They're entitled to do that. But, it's kind of funny when they say we don't care, it doesn't matter, and then they take these actions.
Right. Gary, what does this do for China's export economy?
Well, the key thing here, Rob, is if they weaken their currency, right? Lower interest rates means holding their currency is less attractive, and so it weakens their currency. What that means is that Chinese goods priced in their currency will be cheaper. And so they're saying we are going to continue to export. And remember, a weaker currency for them means imports are more expensive. So basically, what they're communicating to the world is that they intend to continue to run gigantic trade surpluses. And, is that a bad thing? Well, I understand why China wants to do it. It's good for them, but it's not necessarily advantageous to their trading partners. The other thing that's worth pointing out, because these things all have multi-part variables. One of the things that President Trump has reasonably complained about is he's said that the Chinese government has intentionally flooded the US with fentanyl to try to addict and kill Americans. China's denied that. However, last week, the Epoch Times came out with a well-sourced article saying that this was Chinese government policy, that they were intentionally trying to flood the US market with deadly drugs, trying to addict and kill Americans, trying to hurt as many people as possible. And one part of the agreement, or rather potential agreement that was announced this morning, is China has agreed to try to cooperate with the United States to reduce fentanyl exports from China, imports into the United States. If they weren't doing it, then how can they help, right? It's basically an admission that they've been part of this. This has clearly been part of, their multi-dimensional warfare. And what they're doing is horrible. And, we think the Chinese should apologize for this wrong action.
Wow. Yeah. Interesting stuff there, Gary. Great points. And I completely agree. We have to draw a line in the sand. Thing number 5, Gary, now And really the whole point of the episode issue when we're talking about the AI for everyone issue. We're talking about the current White House scrapping export restrictions on AI tech. This is reversing the policy of the prior White House. Thing number 5, Gary, you're going to dive much deeper into this. The White House scraps AI export curbs. Talk to us about that.
All right. So, Rob, the prior White House, the prior administration, they had something called the diffusion rule. And what it was a policy that divided countries into 3 tiers. And depending on which tier they were in, they called it the Framework for Artificial Intelligence Diffusion. And depending on which tier they were in, it affected the ability of people in those countries to purchase AI technology. Now, obviously, we've talked a lot about US attempted restrictions on what NVIDIA can ship to China. NVIDIA has been very clever and resourceful in finding legal ways to technically comply but circumvent those regulations. And I can understand why the prior White House was saying, wait a minute, American technology here is game changing. This is an area where the United States is the clear world leader in AI chips, AI technology. Our hardware and software is by far the best in the world. And so I understand why the prior White House was trying to figure out who should have access to this, because there's a reasonable argument to be made that AI is going to determine a lot of what happens in the future, a lot of the future's winners and losers. Now, this week, the White House rolled back this plan, and they appropriately and understandably criticized it for being too complex, for being bureaucratic. And in fairness, a lot of people looked at the different tiers and couldn't figure out why certain countries were in one tier versus another tier. I understand why the Biden White House thought it was a good idea. I think this was a situation where maybe the intentions were good, but the implementation for these things tends to be complex. And the Trump administration said, okay, look, this isn't working. And, it's important to point out as well that one of the priorities of the current White House is to address our gigantic trade imbalance. Well, one way to do that is to export more high-priced goods where American software and chips and technology are by far the best in the world. And so they're saying, you know what, that we're not succeeding in limiting other countries and what they're able to do. We might as well be the ones selling this to other people. I don't want to criticize the prior White House for this plans, but I do understand why the Trump White House has decided to reverse that policy, and why it made sense for them to try to address this problem in another way.
Gary, wasn't it though just the U.S. trying to limit technology transfer? I mean, is there a complete change in intentions that the U.S. has now as well?
I don't think it's a complete change. I think what they're doing is they're saying having these 3 tiers is not useful. It's kind of arbitrary. We're not necessarily treating our allies like allies and our enemies, if you want to use that word, like enemies. I think the key issue is trade tensions with countries like China. And the question is, how much access to US technology do we want to give China? And one of the things that we talked about in an episode of the 5 Things a couple of weeks ago is the counterintuitive effect that these things have. So, one of the things the US has been doing, and the prior White House did, is they were limiting the ability of the Chinese to buy large numbers of the high-end NVIDIA chips, or at least they were trying to. They were being shipped backdoor, and there were other ways that China was accessing that technology. And while that policy makes sense, remember, if China can't access the US technology, they're going to build their own. And so, it's only a matter of time before Chinese efforts to make their own chips, to have their own national champions that will compete with, Supermicro and NVIDIA and AMD and, all the other companies that are involved in this. It's the kind of thing that they will develop their own expertise. And so it's not a bad idea to try to hamstring their ability to develop their own capabilities by selling them our capabilities, right? It's basically what China has done to the United States. In many ways, what China has done is they've said, hey, US, you're producing products. We can offer you the same products for a cheaper price. And we've spent the last 40, 50 years saying, okay, great, we would love to buy those products from you at cheaper prices. And the advantage is we got to pay less. The disadvantage is we've lost a lot of our manufacturing capacity. And so in some ways, what this will do is try to present China with the same dilemma. Do you want to buy from the United States to buy the best products in the world at the best prices? Or do you want to spend a fortune to try to develop your own in-house capability? Basically, President Trump is presenting China in AI with the same dilemma that the Chinese have presented the US with for the last, 30, 40 years. So I understand the strategy. It's hard to figure out right now who's going to win on this, but right now what we're doing is saying this is what people's intentions are. And so that's where we are.
Yeah, fascinating stuff there, Gary, and thanks for breaking it down for us. This is the AI for Everyone issue of Deep Knowledge Investing's 5 Things to Know in Investing for this week. Head over to our website, deepknowledgeinvesting.com. Sign up for a free subscription. You'll be added to our newsletter. We also have a premium subscription that gives you full access to the website, as well as all of the current recommendations, buy and sell alerts coming from Gary. And then be sure to use our Ask Gary feature on the site too. Send in a question. You might see it end up here on the 5 things. Moving forward, we'll be back here same time, same place next week. So be on the lookout for that. Really excited getting in a groove with the 5 things and keeping in tune with all the craziness that's going on. I know I felt like it was getting a play-by-play update on Twitter, actually, of like Chinese U.S. Trade tariff negotiations over the weekend. So that was a lot of fun and a lot of stuff happening very quickly, and we'll do our best to keep you in the loop. Please subscribe, like, comment, let us know what you like, what you don't like, why you agree, why you disagree. Gary, turning it over to you for the final closing thoughts.
So, Rob, I think you made a great point on how crazy it's all been. Entire markets are moving enormous amounts just on a tweet by the president or a press release or a comment by a Chinese official. It's why we had your portfolio so carefully, because it's hard to tell what the next announcement is going to be or who's going to say what. But you're right. Like, I put this issue of the 5 things to bed on Saturday, and by Sunday, so much had changed. So, that's why we encourage people to go to deepknowledgeinvesting.com, subscribe, because that's where we keep people up to date in real time. Another great week this week by Cash and Crow, DKI intern. He's growing every week, doing a great job. Rob, you and the team at Flying V are always terrific. So much of what we do on the 5 things is because of you and your firm and the people who support you and us. We really appreciate it. And for all you people watching, thank you so much. We know your time is valuable. We appreciate you spending it with us. If you want to like and subscribe, that would be terrific. But hey, we're not the boss. You do what you want. We'll look forward to seeing you next week.
Thanks, everyone.